Beans, cool beans. Welcome to the midweek fundamental and technical analysis. Let's get into it. We're gonna start out with DSY as always. Um, um all right, there we All right, taking you back to Monday. I told you guys that I was neutral, but as the mentor say, if my life depended on it or if I had a gun to my head, my bias was to the downside. And I told you that I wanted to see us break this structure here. And give me 1 second. No, where am I? All right, yeah. So I told you guys that I wanted to see us break this weekly um fair value gap, right? And I told you if we broke that and we closed below it, then price action would run down into this daily fair value gap that we have here on the daily time frame. Um, so we break this down to 4 hour. We can see we got that break and close below that weekly fair value gap yesterday. And then we see price kind of just accumulated around in that weekly fair value gap. But notice how the mentor always says pay attention to the bodies. Why? Because how does he say it? The wits do the damage, but the bodies tell the story. So notice what the bodies of these candles is respecting throughout this 16-hour accumulation that we see from the time we broke that weekly fair value gap right here, right? And these, because we're on the 4 hour time frame, so this would be 16 hours, right? And notice what the body of those candles is respecting. Somebody put in the chat what the body of those is respecting. What do we call this line here of that weekly fair value gap? Let me give y'all a second to drop that in there because I know somebody know. So what do we call this line right here of this weekly fair value gap that these candles are respecting? That's right, Tracy. Consequent encroachment, the 50% level um, of this weekly fair value gap. Yep, that's right. iPhone user. I think that might be LA or nephew. So, yep. And so we see how we getting widths, and the widths aren't they aren't even pushing up above the upper level of that weekly fair value gap, and the bodies is respecting that consequent encroachment beautifully. And then we see the displacement or the breakout break of market structure uh, right here when London open. Right here, we can break this down from the 4 hour to the 2 hour, get a better view. Look how the bodies of those candles respecting that consequent encroachment. These are things you gotta be aware of and you gotta have in your journal and you gotta know what it is because these is the concepts that we trade when we are trading because we're trading uh, technical science that the mentor has laid out for us, that being Michael Huddleston. So um, look how the bodies of those candles is respecting that consequent encroachment. And then we see here, break it down to the hour. 2 o'clock, we get this bearish open going into London. and then we see price just melt for the rest of the day, coming right down into our daily fair value gap that I had outlined earlier in the week. Um, so, and look how the bodies of those are respecting that lower level of that fair value gap. And then today with news, we see the push up to run back into what, this fair value gap right here, and the lower level of that weekly fair value gap. So um yeah, man, pretty solid for DXY this week. Um Moving on to currencies, of course. Um we already know that we are inversely correlated with the dollar when it comes to our currencies that we trade. And so we already know the bias being bearish for Dixie. We know that our bias for our currencies was bullish this week up to this fair value gap that I had outlined here. We see we ran right into that. Monday, um, we had this push up Monday, right? Had that push up and price came back down and retested that PD array of that upward move beautifully. And then we ran away from there, from that PD array. Um, so yeah, we ran up beautifully from that PD array. Price respected that buy side liquidity level that we took right here, that high, that previous high, and look how those bodies respecting that. And then we had this quick run down, this wick down right up into what, this fair value gap. That probably consequently approached. Um, yeah. But yeah, right into this fair value gap, and then price ran up into the daily fair value gap that we was looking forward to run up into. Let me break this down to the hour. Yeah, that was beautiful. Yep. So you currency traders, y'all should have field day with currency this week. Looking at GBP USD, same thing. Um, let me get to that daily. We wanted to see that run up in there, and they ran up in there beautiful. So, um, let me break this down. Let me see how. Oh yeah, that was beautiful. Yeah, beautiful. That's beautiful. Look how them bodies respecting that. That's beautiful. That's art, man. That's art. Um, NZD. Yeah, even NZD had some act right this week. She usually one, she a runner, she a track star. She do her own thing. But she had some get right this week. So yeah, man, y'all should ball with currency this week. And now getting into them futures of the game. Yes, sir. Um, I told you guys in the Telegram group that I wanted to see E-mini reach up, E-mini S&P 500 reach up and run 44.35. That's what I put in the silver group chat. Monday morning about 12 a.m. in the morning, something around about that time, 12 or 1 a.m. Told you guys that I would like to see S&P run up and run 44.35 on the September contract. That's what I said in the group chat. And yeah, that's pretty much what we got. And I'm gonna break this down right here. Yeah, that's good. Yeah, that's beautiful. Yeah, that's beautiful. But yeah, price opened up Sunday. We ran up Monday. Um, and had all kinds of opportunities to loan the market off of this fair value gap here. Um, yeah, yeah, yeah. Mm. Mhm, mhm. And yeah, we definitely overbought. And futures just keep running up. The market just keep running up. I can't wait to hear what our fundamentalists gotta say. But yeah, this right here at 8:30. At 8:30 is an important time. You should have in your notes about 8:30. I'm pretty sure you've heard ICT said plenty of times that if you trade New York sessions and you don't know what's going on at 8:30 when the market opens, you ain't watching the market, then yeah, you ain't doing something right. You're not doing it right. Point blank period. 8:30 is a very important time in the market. It's a very important time. That's why it's called time in price. It's times in the market where the algorithm makes certain movements and certain runs on certain areas of liquidity because the market is either doing what? Reaching for liquidity, reaching for buy or sell stops, or consolidating. It's only doing either one of the other. So, what does price action reach for here at 2:30 at 8, I'm sorry, 8:30 yesterday morning? What does it reach down into? It reaches down into a fair value gap. And look how it reacts to it. You gotta be aware of these things. You gotta be aware of them because, like I tell you, like I say in my mentorship, price action literally talks to you. It gives you signs. All you gotta do is pay attention. It literally talks to you. This is price action talking to you. It's telling you. It's showing you. And we got the tools to know what to look for. We see our imbalances in the form of PDE arrays, in the form of fair value gaps. So we know what this price action or what the algo is reaching for right here at 8:30. We know we already got it identified on our chart. We should have it identified on our charts. And when it reaches for it like that and it reacts the way it do, and then it immediately does what when it reacts to it and closes? It creates another what? Fair value gap. Look at that. It's talking to you. It's painting a picture for you right there. It's boom right there. So if I'm saying I'm wanting price to reach for 435 for the week, that's my analysis. And we see this movement right here. When we see price pull back up in that fair value gap, what do you think it's time to do? It's time to get in the game, baby. It's time to get in the game. You don't have to risk a lot on that. You could have put your stop loss at consequent encroachment of that fair value gap and put your I'm sorry, you could have put your entry at consequent encroachment of that fair value gap and put your stop loss right below the bottom of that fair value gap. Keep it tight. You don't care about if your stop loss get hit or not. You rather it get hit and be wrong and lose a little bit than it get hit and be wrong and you lose a lot. Now not only are you wrong, but you lost a lot when you can be wrong and lose a little and readjust. Um, because at the end of the day, one of the most important aspects of trading is that risk management. You know, I am the risk management police. So, woo, 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 woo. Yeah, that's me. But yeah, so I mean, it's laying it's painting the picture for us clear as day this week. Um, and we ran right up into that level. Look how price respected that level. And then what do we do? What do we see? We see that 2020, we see that 2022 model, right? We see that um, run of a higher time frame, liquidity. Let me see. Yeah, we see that run right here of a higher time frame. We on an hour, right? We break that down to the 15-minute. We see that run of that, right? We see a higher high form, new buy side liquidity. And then what do we see? We see the short term low form. This is the 2022 model, guys. Higher time frame, rent, new high set buy side liquidity, a short term low rent, creating a fair value gap. When we see that short-term low rent right here, what does the run of that short-term low create? A fair value gap. Where do price come right back up into? That fair value gap. Yeah, it wicked a little bit over it, but the body ain't even nowhere near close above that fair value gap, right? So that's entry. The stop loss should be up here to come down and run you would say sell side liquidity, but you should be taking partials in this. Well, I take that back. You shouldn't say sell side liquidity because we're bullish. So yeah, if you take this entry here, you would be taking profit in this fair value gap. Because we can't be bearish yet until we break sell side liquidity on higher time frame. Know that. So yeah, that would be our exit right here on this entry. And then the markets comes up and accumulate into the close. I mean, you can't get no more. Like that's just beautiful. Uh, Dow didn't have U30. She did what she wanted to do today, but Nasdaq was in line with S&P. I didn't even drop them in the group chat, but uh, they correlate with E-mini, so I'm expecting them to run up too. But U30 was, as the mentor says, the sixth sister this week. So, or today. Um, and I ain't even gonna play with it. I don't know if she's gonna open up and get in line with ES and NQ or not. So, I ain't messing with it. It's so strange because U30, that's my baby. But since I've been trading ES, she does give you like more cleaner setups, ES and EQ. And U30, she like, yeah, she feisty. She do what she wanna do. Um, yeah, but when I mark her up, when I analyze it. But I just have to get in tune with her. And right now, I'm in tune with ES, and that's it. So I'm just following what works, and I like ES. So I'm going to now I ain't gonna show y'all how I did that projection on the call. I'll show you that after the call. So there's futures. Oh yeah. I skipped over metals, y'all. But yeah, we wanted to see price run up into that into this fair value gap, this daily fair value gap. We pretty much got that last week Friday, but we got it again yesterday. Um, then we sold off, and today we pushed back up. Um, I don't know. We bounced off of that PD array yesterday. Um, I didn't even mark that. Yeah, let's see. She came back. Oh no, she didn't. Oh, yeah, okay. She gets on the 50 though. She, yeah, she respect that 50. She definitely gonna run up. That's a bet. She respect that 50 field. She definitely gonna run up into this. Um, but let's see if she pull back down into today's PD array. Um, we can get up in there for gold. Um, what gold wanna do? Go acting like she wanna reach for 1885. I don't know. Silver looking like she want to continue to run up because gold didn't get nowhere near its fair value gap. I mean, what was this? Hmm, I mean, it didn't break it though, like silver did, but it doesn't have to. But I would like to see it. And let me see some. What's the, man, liking the in counter with these long widths. Let me see. Throw this on. And it's long like that. You gotta measure that width and measure that 50% mark of that. Oh, that's close enough. Yeah, I'm cheating, but that's close. um, um, oh no, gold might want to fall down. We gonna see. I'm not gonna fall down. Let me just throw this in here. Mhm. Man, we got a little sales side liquidity. It might want to sweep before it go up. You know, some here, some here, some here. Okay, well, you know, we'll see. Back to the day. Yeah, we'll see. She look like she want to fall off though. Like she want to come down and retest this auto block right there. We'll see though. See what she give us going into London. Oil. She don't want to get up above that 75, boy. She don't, but she going to. Best believe that. She going to. We gonna longer all the way up to believe that. Um, last but not least, crypto. Boy, they regulate. They regulate. Regulator. Yeah, come out and play. Yeah, damn, I'm telling my age. Look, um, yeah, they regulate. So I told you what to expect if we broke. Yeah, we broke it. So I'm expecting us to run down to 24,000. Let me see this low. That's 23,931. I'm gonna look for us to run that. Run on down in here. Uh, the mentor says his concept don't work on. He's not sure. He don't say they don't work. He say he's never used them for crypto, but I beg to differ. They work. I just want to mark them as consequent approach, man. So I be ready. Yes, sir. Um, the little alert right there. And yeah, we're gonna look for the run down into there. Uh, this back up give us a little fat value gap right here, probably. This would be a little fat value gap. Just the daily time frame, keep that in mind. Then we'll probably see it swing down, hit that top level of that daily fair value gap first, then swing back up there into that one more time for everybody who think it's just gonna fall to the floor. You gotta squeeze them out, run up in that fair value gap, and then we'll probably fall down to that consequent encroachment, and so forth and so forth if they decide to squeeze, squeeze, squeeze. So there you go. So if we broke below there, then we should see us fall down in there. So we see. One, see how we react now. Push up and then create this fair value gap. You already know we can't get above this fair value gap, this structure right here. You know where we going. Right there where I got identified. So what's that? 1560, 1550. So we'll see. You know, I know. It's time to buy more. This is the time. I know it's scary to buy, but I can't understand for the life of me. Like I've been doing this like 7 years now, and like learning from Corman for like 8 years, and it's just it baffles me. Like I'm still a baby to this game, right? Like that's what y'all gotta realize. These markets is a lifetime thing. You're gonna be playing these markets till you die. You know what I mean? So, um, the more knowledgeable you come, uh, the more knowledgeable you come, in it now, the better. You know. So, but it baffles me. It's like I seen this last cycle too, the last bear run when everything went to shit. It's like people are scared to buy when things are low. but they will throw crazy amounts of money when shit is high and it's already pumping. Like it's insane. And it's like the complete. You're supposed to do the complete opposite. uh, oh yeah, but I'm dollar cost averaging in the Acorn. It's at $2. Like I said, I believe in Yuga Labs and what they're building for the future. I'm thinking like long term. I'm thinking like 5, 10, 15 years out. Yuga Labs ain't going nowhere. Like they ain't going nowhere. They own too much IP in the Web3 space. They're building too much shit. Like they're literally building the Grand Theft Auto, what I believe is going to be the Grand Theft Auto of Web3. And for anybody who knows how big Grand Theft Auto is and Rockstar, then you know that shit is legendary. It's not going anywhere. So I mean, yeah, I wanted to go down to 50 cent and scoop up more. Cause that's how the game go. But hey, not financial advice. But I like what Yuga Lab is building and I like it. So it is what it is. Dollar cost averaging for myself. Um Other than that, that'll wrap up the midweek technicals. At this time, I'll stop my share and pass it over to the corner. It's all yours, corner.
All right, cool. Um, I was sitting here as you were talking, and I was writing some notes. Because I just completely changed what I was going to talk about tonight while you were talking. So I'm like trying to put my notes together.
Yeah, I hope it won't get not sick.
I was like, wait, hold on, like scratch, hold up, back up. I done look, y'all. This is how crazy my note taking is for these calls. I'm like taking notes out of two different notebooks. I have a notebook that I take out of the house with me, and I have a notebook that I take with me, or I leave here when I take. So I'm like, when I'm sitting here and I'm just thinking about stuff, I write in one notebook, and then when I'm like out or whatever, I use the other one. Man, so um, yes, we are. Oh man, all right. So hold on, wait. See, I flipped the page and now wait. Why? Mm, see. All right, cool. Yeah, yeah. Here we go. All right. So, all right, yeah. So it was a couple of things. So I am going to share my screen. Um, what in the world? Okay, y'all, this is crazy. I literally only had like I literally only had like 5 tabs opened up when we started this call, and somehow now I have like 12 tabs open. Listen, this is insane. Um, do I need this one? Uh, no. No, I don't need this one. All right, cool. Alrighty. Yeah, let me go ahead and share my screen now. All right, I'm good. I'm going to be taking my fundamental like analysis from 2 notebooks tonight, so bear with me. I am just going to be page flipping and talking. All right, so this week we had lots of news, still have lots of news coming out. So I'm going to like go slowly because I really want you guys to understand what is showing up and happening on your charts whenever you are looking at them. If you've been on calls with me for like the last couple of weeks or so, even when I've done like the calls like on my Zoom and whatnot, like we've covered a lot of this, but not everybody was able to participate. So I do want to review it because I'm slowly and but surely starting to realize like these are like the concepts that you really have to know and understand. So today, FOMC, I'm not skipping that. That is huge. That's like the main part of what I'm going to talk about tonight. So I'm going to come back to it. Tomorrow, we literally have the news that helps to stabilize global economies. And we also have the news that's coming out tomorrow to help fuel the next Fed meeting. So if you remember my talk from a long time ago, you guys know that the Fed gets this news. So the Fed, this news that's right here, that's showing up for 8:30, 8:30. If you don't, actually, if you've been on a call with me in the last couple of weeks, put in the chat if you remember why 8:30 is important. But I'm gonna keep talking while you do that. All right. So 8:30 in the morning is when this news is going to come out. Any economic news that you see on the Forex Factory calendar, if you go back to 2 to 3 o'clock in the afternoon on the day before, the Fed already has this news. So don't really like, so when they say that the Fed has to account for this news in their next meeting, yes, they do. But at the same time, a lot of what Jerome Powell talked about kind of hinted to you that they already kind of sort of know what this news is, and it's because they do. They get this news early. They have all these numbers and stuff. The press gets this news early so that they can make the teleprompting and do all that kind of stuff. They don't get it like as early as the Fed does, but they get it early. Hedge funds, people on the floor, they get this news early because they are the ones trading institutionally on behalf of clients who have huge amounts of money built into the system. So you have to think about it like this. The money that you see being traded on a day-to-day basis is your money. If you work a 9 to 5 and you have a 401k, that is your money being traded in that market. Some passive investor or active investor is there trading your money. If it's a new quarter, your money's being traded by a passive investor because they typically do that on a quarterly basis. They'll go through, reassess their portfolios and say, okay, do we need to do anything? Do we not need to do anything? Okay, cool. Put more in, take some out. So they're like on the passive side, like there's something working with your money. An active investor is a person that is sitting there calling the floor, hey, I need for you to transfer X billions of dollars in this fund to this fund because we're now needing to shift to a more aggressive or to a more balanced portfolio for these people or for this amount of money because we see that the markets are shifting. So we need to protect our clients' money. That's what you're looking at. So that's why you got to get it through your head, if you haven't, the heads of those people around you, that, hey, if you have a 401k and you looking at the market and you talking about, oh, the market crash, you hoping your 401k crashes too. So I hope it's self-managed. I hope you're doing it with your own money because if you're letting them control your money, oh, you're hoping for your 401k to fail. And here's the thing. We have this whole group. We talk about baby boomers. We talk about Social Security running out. Ain't nobody talking about the fact that we're getting ready to go into a recession when baby boomers are retiring and starting to look at their accounts like, I don't know if I'm going to be able to retire in 2023. You're not going to be able to retire in 2024, maybe 2025, once we possibly have a new administration or we go into another Biden administration, whichever one happens, and then it's a new term, then we have a recession. Like, your 401k is not going to grow in market stagnation, stagflation, as they call it. So anyway, that's that. The Fed already had this news. But however, what the markets are going to be reacting off of is the fact that there's core retail sales, Empire State, core retail, regular retail, unemployment claims, all coming out tomorrow. Philly Fed is a minor news item in all of that, but it all matters. All of these are those news items that typically, like, they matter a lot to the economy. And yes, the answer is in the chat. So at 8:30 in the morning, Eastern Standard Time, if you don't have this in your notes, please write this in your notes somewhere. At 8:30 a.m. Eastern Standard Time, there is an injection of liquidity into the market from the FedWire clearinghouse. It comes strictly from FedWire. If you did not know, now you know. Why the 8:30 candlestick is so volatile. That is why. There has to be an injection of liquidity into the market at 8:30 in the morning to make sure that US businesses can function for the next business day. Why is it FedWire? Because if you remember back to 2007, 2008, when those businesses couldn't function and they were calling their bank, trying to get money and loans to help their operations for the next day, these things happen on a daily basis. That overnight period of time, technically right now when clearinghouses are taking in orders, figuring out what needs to go out for the next day. And when I say clearinghouses, I mean like clearing orders for businesses to transfer money to other businesses. That's an order. For a government to transfer money or an asset to another government, that's an order, like one order. But there are hundreds of those happening in the marketplace right now, all up until midnight when that next cutoff period happens. Then after midnight, you roll into another cycle going into London because there has to be a block of money allocated going into London session. And then you have another block of time at 6 a.m. where money is allocated to go towards New York session. And that money is delivered at 8:30 in the morning. So 8:30 is a very important time. Why does news always come out at 8:30? That is why. So that is that. Wait, I can't read the comments while I'm talking. All right. Okay, so 8:30, 8:30 in the morning. Remember that. So that is why. And FedWire, all the other clearinghouses that I'm talking about, they all are doing this simultaneously. So it's not just one clearinghouse that's transferring money. All of them are transferring money. But it's specific to the United States when we talk about FedWire. All right. So to go back just a little bit, because I think I kind of skipped over it. Euro has the same news coming out today. I mean, sorry, tomorrow that we had come out today. So I'm either expecting that they're going to halt or they're going to do a small increase. They have to get their currency on par. If we've flattened and halted and we didn't change our rate at all, then it's highly likely that they won't. But at the same time, they have to make sure that they create a very stable balance between the euro and the dollar. If they do not keep the stable balance between the euro and the dollar, euro USD is going to look really jacked up. Like really jacked up. How jacked up? You remember during Brexit when the US was doing all this crazy stuff with their rates and the euro really couldn't do anything with theirs and the market just looked like it fell off a cliff? Yeah, euro USD is going to look very crazy. And you're going to have the euro slide against the dollar if they cannot create a good balance in interest rates, because that's essentially how you're valuing your money overnight against another currency and determining its value. So that is very important. There's also a press conference. Um, Japan, tentative. It might be at 9, it might be at 10, 11, 12, 1 a.m. Who knows? They'll let us know an hour beforehand, but JPY has this news coming out. And honestly, Japan is a factor, but Japan hasn't really been as big of a factor as they had been before. A lot of countries are starting to see the writing on the wall, and they're starting to recall their cash, meaning if they have treasuries and all these securities stored up in the US dollars, they want their money. They're like, I don't want to hold these US bonds, aka US debt anymore. If you can come that close to a debt ceiling and you guys are fighting and politically you guys are not on the same page, can't get on the same page, don't like each other, give me my money. I'll take a small penalty, but give me my money. I can do better somewhere else. So, Japan's news is still important though. We'll still look at it, we'll still pay attention to it because they still interact with a lot of economies within Asia that are our allies and also countries that we don't really like. So it will be interesting to see who helps supply the country with the backing that they might need financially, should they need it. And then Friday, consumer sentiment, and then inflation expectations. I kind of like talked about that a little bit when I just like reviewed this quickly last week. All right, but today, so FOMC, if you did not watch, it is on the Fed's website. The whole press conference is here. If you don't want to watch the video and you want to read it, it's right here. These are the economic projections. I'm not going over those because it's the same stuff they've been showing us since COVID. FOMC statement. This is essentially talking about maintaining the current rate, 5.25% or basis points. Well, percent. I'll say it in percentages. 5.25%, and then still trying to reach 2%. Honestly, in my opinion, the whole notion of trying to get to 2% and why 2% is a goal, I don't want to call it stupid, but I will say that it's an archaic way of thinking. It's super archaic, actually, because that way of thinking comes from the rate of return that they pay on retirement accounts, and it also comes at the rate of return that they felt like gold would come out of the ground. So I don't understand why we're still using that metric, although I do, because if they were to base retirement accounts off of the real interest rate, then they would have to pay people. So for instance, if someone had a Social Security account and they say, well, our target inflation is 3% and not 2, and 2 is out of the question about being the target, that's 1% more money that they have to pay out. As you could see from the debt ceiling, the US can't even get its basic bills paid. And speaking of debt ceiling, because this is going to come up actually now, I'll just go ahead and show you. The US is broke. I don't remember. Let me see who's on the call. I think most of you were on the call when I showed the US accounts and what they look like. The US is broke. If y'all look here, I told y'all it updates every week. So if you want to know what the account's looking like, come here every Wednesday and look. It updated. So this is as of June the 7th, even though I can't get this curse. Oh, there it is. All right, so June 7th, you see it on my screen. It says Wednesday, June 7th, 2023, 44.756. billion. When I showed you guys this, we were like somewhere, I think we were like at 78. Somewhere in here, it's like either 70 or 60. I think I just rolled over it. But anyway, yeah. So the US accounts are looking dry. So when they tell you, oh, the debt ceiling is over, no, it's not. You see this? You see this 44.7 something, $5 billion? The account ain't been that low since way back here in doggone 2017 when it was like 37 billion. And you see what happened. They printed money, printed money, printed money, printed money all the way up to like the $400 billion level, maintained that, and then the accounts ran dry. And then this right here was when they started having to do actually we were like right, and it was actually working. But what happened? All of this extra spending that had to happen when they adjusted rates. Then here we come here. The Fed gives this whole press conference talking about rates again, talking about how there's going to be in the economy. I thought that was so funny because here we go, having to print money right back in here for COVID. And then here's the COVID injection of money. And then there we go. Anyway, we're dry. We're due for an injection of funds, which means that Janet Yellen gets to actually do her job now. And what is she going to do? Dilute the dollar. So today, I am relating this to more news from today, I promise you. Today, Jerome Powell said, which notebook? Okay, that policy is going to remain unchanged, which means that 5.25%, they were not changing the rate. They plan to reduce their security holdings. Can I show you guys something? You see this? You see this? Anytime we've been this low, what happened right after? So what I'm saying to you is, because what I spy with my little eye is that Jerome Powell just lied because he feels like the people don't know any better. But anyway, what am I saying? I can't call Jerome Powell a liar. But I mean, we are about to get a huge injection and dilution of the US dollar coming into the market in the next like 6 to 8 weeks. So, whatever. Anyway, back to the Forex Factory calendar. So, there will possibly be 2 more hikes between now and the end of the year, which is why when you look at ES, that's why the chart looked kind of crazy. Actually, if you happen to not see ES, this is on the monthly, so it's zoomed out way more than just today. But anyway, I'll wait for it when it decides to change. So the thing about the charts from today, if you follow the charts when anybody is speaking, you will actually get a chance to really see like how the markets function off of this news. So markets did very well when they were talking about not hiking. But the minute he started talking about more hikes, possibly like in the future, that's when the market decided that it didn't like the news. The market was like, wait, you said, but now you're saying, so like, what is it? The market was very confused today. And I just really want this chart to work so I can show you guys something. But, oh my gosh. It's okay. I'll talk to you while I'm doing this. All right, so anyway, if we look at all these charts today, you will see that there is a correlation in sectors of the market. Some people might say, well, knowing the sectors of the market aren't really that important. I beg to differ, and I'm going to show you why. Oh my gosh. Hold on. Actually, no. I'd rather see it on the monthly. It shows you better. Sorry. All right. All right. So now, when you look at these charts, wait. I put them up on in the wrong order. So I want you to be able to see it better. Okay, here we go. All right. So now, whenever you look at these charts, Mr. Levels already covered earlier that the Dow was the sixth sister between the three. So you can clearly see, because the top chart is S&P, the middle one is NASDAQ, and then the one at the bottom is the Dow. But why? So I want you guys to understand something else. You have to kind of know what's in the index to know what to pay attention to and to understand how the index is going to function. You don't have to know everything, but like at bare minimum, if I ask you, what's the top 10 weighted stocks in the S&P? Could you tell me? Or if I said, what's the basis for NASDAQ? Could you tell me? Or if I said, what are the sectors that make up the Dow? Or if I said, hey, what are the 30, because it's the Dow Jones U30. It's called U30 because there are 30 stocks in the index. Can you tell me all 30? Well, I'm getting ready to give you all the answers. So ES, top weighted stocks are tech, NASDAQ, tech, and pharmaceuticals. The Dow, while yes, it does have a couple of tech companies in it, it is not heavy on tech at all. The Dow has, wait, I gotta go through the companies now. I think there's about 10 different sectors. So you have about 3 stocks per sector. So let's see here. All right, so Caterpillar. Okay, so let me tell you the sectors first. The sectors are consumer staples, industrial materials, industrial, financial, telecom or telecommunications, energy, consumer discretionaries, information technology, and healthcare. It's smaller. The weights are more divided between other sectors compared to the S&P 500 and the NASDAQ. So when you look at NASDAQ and S&P on this chart, you can clearly see how they have all been functioning and moving starting around January or so. I mean, even before that, but before there's like a break in this correlation. I guess you could still call this part of the correlation. So I say up until September. We'll just call it September. Why? Like when you start thinking about the news that came out around this time, the end of the end of the third quarter, beginning of the fourth quarter last year. Why all of this? I think so. I think this is being recorded. So why all of this correlation here? So this correlation in the market is because of sector weight. You have to know and understand what sector weighting is in whatever index you trade, because that is going to point your eye into the direction of what companies you should be paying attention to. Like, people are like, oh, I don't understand this bull run. I understand it. It does not make sense. I can show you why it doesn't make sense. Um, video. It's not all. All right, so here we have NVIDIA. When you look at NVIDIA's price to earnings ratio, first of all, it makes you scratch your head at how you can even get to a price to earnings ratio that is that high. That is astronomical. That is like ridiculous. Tesla is another one. When you look at previous price to earnings ratios, for these companies, they're high. And even with NVIDIA dumping today, essentially, it dumped for a little bit, but not for long. And oh, you said pumping. It dumped for a little bit right here. Like, if you look at their chart, it dumped for a little bit. And you could tell immediately that right here, people bought back in. And then, wait, when was it? I gotta find the chart. I hate these. I'd rather have, oh, here it is. Right here. So all of this price movement right here, this was not NVIDIA. All of this happened on every tech chart because this was leading into the week. There was news that came out at some point in time late on Monday because there was speculation that the Fed was not going to raise rates. This tells you a little bit about how this news comes out with the Fed, and like how news kind of sort of gets leaked out of these meetings going into the week, so that it's known like how to trade. Here, the market as a whole, every market you look at kind of sold off during this time. And then there was more news reassuring the market that the Fed was not going to dump. Was not going to change rates, sorry. So as you start to get into today and you actually hear what the Fed had to say, companies like NVIDIA love the news. Companies like Tesla really should have did more than what it did today, but Tesla's been on a run. If you look at Tesla for the last month, this is Tesla. For where Tesla is now compared to where Tesla was a month ago, 167 to 256. So if you think about the percentage of increase that these tech stocks have had, Apple boomed on news. So Apple had WWDC. Um, they've had a couple of other news items come out. This was that news came out, WWDC though, about the new tech innovations where they didn't talk about AI and they introduced Apple Vision here. And then the market's coming back to somewhat recover this level again that the market peaked out at. Um, you can just go across, and there's a reason why I'm highlighting these. I'm going across the sector to show you how stupid Nvidia's price to earnings ratio is. AMD has a very stupid price to earnings ratio as well. Across the whole sector, all of these companies that drive these two indices are way overpriced. Way overpriced. People are pumping money into these companies right now because people are essentially on a tear. People are trying to figure out how they can get their money for between now and the next Fed meeting. I have no doubt in my mind that the market's going to continue at a somewhat decent pace. But when one of these hikes happen, you're going to have a pullback in the market. These markets don't like rate increases. The market has already had to adjust to these rate increases. And the market still doesn't really like it. And that's the whole point that I was trying to get across before, and I'm still trying to get across now. Like, the market sold off here like last year. When you look at what happened at the beginning of the year, how these markets sold off, and then you start looking at what happened this year, like, yeah, we were kind of like flattish going into the year, but now all of a sudden in the summer, you I don't know if you guys know what the saying is in the like trading world with stocks and stuff, but it's like sell in May and go away. Nobody selling in May. There was not a lot of selling that was happening in May. And then in June, this month, like we're already pretty much halfway through this month. Like, you literally are watching markets do things that they traditionally don't do, aren't supposed to do. So it makes you really question when the market reality is going to set in. When are we really going to get to the point where the markets are like, all right, like we've had enough. So I want you to know what these stocks are that are in the Dow to understand why it's not really performing. Verizon, Intel, Walgreens, Coca-Cola, Dow Inc., Cisco, Chevron, Johnson and Johnson, Apple, Travelers, Amex, Walmart, Caterpillar, McDonald's, United Healthcare, Goldman, Microsoft, Home Depot, Procter and Gamble, JP Morgan, Disney, 3M, Nike, Visa, Amgen, Honeywell, Biogen, Salesforce, IBM, Merck. Those are the companies that are in the Dow. And as you can hear, they're like variety. There's a huge variety there. And I'm going to say this, and I'm going to be done. Know what the top 10 are. I use because I just like to look at so like I'll go to slick charts and I'll literally just stop sometimes at like the top. I'll like sort it by weight and just look at the top 10 and just see what the top 10 did that day. Because your heavily weighted stocks, they're what's going to really move the market. So when you're looking at this list, it's like, all right, I can stop at Salesforce. Everything below Salesforce is like 4%. I want to see what these stocks did today. And when you see that United Health, the heaviest weighted stock in the index, was down almost 6%, okay, Here we go. Then you have to look at healthcare. Like, why was healthcare doing so bad today? Then you have banking. Then you have a tech heavy company. But this just goes to show you that Microsoft, even being the weight that it is, you got to have another company that's like in the top 5 doing well just for you to even really like have a good day. I don't want to say it like that, but I mean that's kind of like what it amounts to. You do the same thing for the S&P 500. What did I say? Top 10? Apple, Microsoft, Amazon, Nvidia, Google, Tesla, Google Class C, Berkshire Hathaway, Facebook, United Healthcare. That's so tech heavy. And Apple and Microsoft make up like 14%. Like when you think about those heavy companies, and honestly, when you talk about the top 5, you really have to include number 7 because both of those are Google. They're just different classes. So it's like when you start seeing these same companies, NASDAQ, over and over again, Microsoft, Apple, Amazon, Nvidia, Tesla, Facebook, Google, Broadcom, and Pepsi. Look at the companies that you see. So that's why. So like when you're like, oh, well, why didn't it move? Or why are S&P and NASDAQ moving together? Look, the top 10 companies are pretty much the same. Like 80%. 1, 2, 3. Like really, yeah, 80%. About 80% of both indexes, top 10, are the same. Like, so that it's going to be really hard to break correlations with these two. If you break correlation and you see that these two are not moving together, the first thing you should do is go to Slick Charts. I just showed you where to go. Go to Slick Charts and pull up and see what is outperforming tech, because that's what has to literally outperform in order for them to not do well. Something in tech has to be going wrong. You have to figure out which tech company and why. Is it Tesla because of the car? Is it Facebook because they're going to Congress again? Is it Google because they are having some issue? Did PepsiCo have a really good earnings report? Did Broadcom have something really good that happens? Like whenever you whenever you're looking and you're trying to really figure these things out, like just scroll down the list and it will literally tell you. Like, so I don't want you guys guessing in these markets, obviously. Like, whenever you really have questions and you're trying to dig in and you're trying to like figure out these market correlations and you're trying to figure out why, what's what, come to Slick Charts. Like, I've shown you guys a lot of websites, but for index correlation, come here because the weightings change. Like, I'm trying to figure out which company it is. Okay, so they already kind of threw it on here. So Palo Alto replaced Dish. Oh no, wait, hold on. That was supposed to be S&P 500. So Dish is being replaced on the ES. So Dish is going to be replaced with Palo Alto. So you always have to make sure, and it doesn't happen all that often, but when a company falls off and when a company is not performing well, you remember how I talked about passive investors and these active investors going in looking at how to reallocate money. That's what happens on the S&P 100 quarterly. They're constantly making sure that you get high returns on the S&P 100. And the S&P 600 as well. So like you have to go through and like look at these things, like really figure these things out. Like all the data is here. I'm just trying to dig through all the archive notes and try to figure out how to get it to you so you can get it and understand it. You can definitely trade. People ask me all the time, can I trade and not know anything fundamentally? If you're a strictly technical trader, you can, yeah. but it helps to understand the markets and understand why things happen the way that they do. If you don't care about the why and you're just trying to get to the end result, okay, but that you might miss something along the way that could actually help and benefit your trade. So for me, technicals and fundamentals go together. And then you just lean heavily towards one more so than the other. That's why Mr. Levels more technical. He knows fundamentals. I'm more fundamental, but I know some technicals. So just pair them together. And when you really like go through these calendars and you just understand the calendar solely for when markets are going to be volatile, not don't try to understand every little thing about all these news items. Just understand that the market is going to have more volatility during that period of time. That's it. Just do that. Just know, okay, that's big news. Market's going to be, pretty volatile. Okay, cool. That's it. As for if you're a futures trader, slick charts. Look at your weighting. When you see what the weighting is for the index that you trade and you can find the correlating indice or the index for it, trade. Go into the market day. If you're strictly U30, I'm saying this and I'm really going this time. If you're strictly U30, all you do is trade U30, at least know what the top 10 weighted stocks are in the Dow so that you can prepare yourself and you can kind of know what you need to pay attention to and what those companies like. Last little thing. Sorry. Sorry. Okay. Last thing, I promise. Because tech, people wonder why like tech freaks out with interest rates and then why tech is like booming now. Tech got all the free money. Tech and banking got the cheap money during okay, cool. I got the clearance to take my time. Okay. Tech got all the free money during like this right before the big, if you missed it, right before this big bull run right here, right before all of this, Tech was getting all the cheap money. Tech was getting all the cheap money. How do I know Tech was getting all the cheap money? Because look at the chart. The chart tells you the weightings have not changed in a long time for the top 10 stocks in these indices. For the Dow, yes, because of Apple's weighting. Apple's weighting changed in the Dow, but you can still look and see, like, okay, like this is recession. This is recession. It doesn't look like it because these candlesticks are super small. And I didn't want to lock the charts together. But this is recession. And then you see what happened. You get an injection of money. This is oh my gosh, CARES. Nope, maybe. Obamacare. This is all like all the stimulus that went out from that period of time. All of this money flooding into the market. That was cheap money time. Like super cheap. When you look at how interest rates were, I don't know if I can do it because I already have 3 on here. Oh no, can I do it? Yes. Oh no, that's not what I wanted. Wait, sorry. Yes, okay, cool. Now look, see what I was talking about? Interest rates, cheap money. That was when rates were like flat. Rates were flat, so that money was cheap for tech. Then rates started going up, but the market didn't care because it wasn't like crazy. But This is when the Fed had to start adjusting. Remember when I showed you the chart earlier from when the Fed had to start adjusting their policy towards the end of 2019? This is it. And then COVID happened and they had to drop rates flat again. We were in the middle of adjusting for this inflation right here. Then they had to immediately drop the rates to zero in order to provide liquidity into the marketplace so that businesses could function and stay open during COVID. And now we're here. Technically, we are doing what we should have continued to do way back here. We're still on course for the recession, though, believe it or not, because all of this interest rate increase going into 2021, we're pretty much on par almost. It's kind of crazy how we're almost dead on for where we overshot it by a little bit, but we're pretty much on par for where we were supposed to be. Now, what happens to an economy? You don't have to answer because I'm gonna tell you the answer. Kind of rhetorical question. When an economy starts raising rates before it's ready, and when an economy has to drop rates before it's ready and then raises rates astronomically high, you are at a 81% chance of having a recession. Why? Because we were in the middle of flat rates and a gradual increase. The Fed had said here, hey, you know what? Time for cheap money is over. We're going to slowly start raising rates again. And then, oh no, summertime comes, the economy is not looking the way that it's supposed to, and there's some trouble in the market. That's literally what Jerome Powell said in the press conference that he gave in like August. It was either August or September. He said there was trouble in the market. Oh, wait, and then COVID happens? Oh, dude, he has the crystal ball. He knew trouble was coming. And then rates immediately went to zero. And then here we are. Look at how steep this incline in rates is. Markets don't like that. Stocks don't like that. Tech companies don't like that. Look at how, when I put my cursor here, and you see where the stock market was, and you see where rates were. And then as rates went up, look at what happened. And then markets start adjusting to inflation, pricing, and people start adjusting to rates and pricing. When people start adjusting to rates and pricing, then you see this move in the marketplace, because now the markets think, all right, well, now the Fed is adjusting, we've adjusted, they're going to flatten out rates, but what are they going to do? Because now they have to make up for these COVID losses. They're going to keep price the same. People are used to now paying $5 for a bottle of water. Why drop the price? People are willing to pay it. We're going to keep making them pay it. And guess what? Their materials cost is going to get cheaper. How do I know? You can look at the commodities market. You can see it. When you look at oil, you're not just looking at oil as in gasoline and kerosene and natural gas and all those derivatives. You're looking at it as plastic. That's where plastic comes from. So when you've seen the price of oil drop, well, plastic got cheaper too. But guess what? They're still selling you that bottle of water for $5, but their cost went from 3 down to like 50 cents again. So what is all of this? You're going to start seeing the earnings reports start looking kind of crazy next quarter, quarter after that. Companies that weren't supposed to be posting profits are going to post profits. Companies like Pepsi, Coca-Cola would not surprise me at all. And they're going to say, oh, consumers love their sugars. Consumers love their snacks. Consumers love their sodas. Even if you can break it down and look at Gatorade versus Powerade and Aquafina versus like all these different brands and break it down into like each individual little company that's in their conglomerate, you're still going to see the same thing. You're going to see profits in areas where profits were like really shouldn't be. Anyway, I think I'm done now. Yeah, I'm done.
Saucing. Yes, sir. You dropped that sauce tonight. Good. God almighty. You better come on through with that sauce. That unicorn juice. I can dig it. I can dig it. Well. That will wrap up the midweek fundamental and technical analysis. At this time, I will stop the recording and take any questions. Peace and love, family.